Welcome. Today we're diving into the world of mutual funds, a popular investment vehicle that pools money from many investors to invest in stocks, bonds, and other securities. Managed by professionals, mutual funds offer a way for individuals, whether big or small investors, to access a diversified portfolio without needing to pick individual assets themselves. Over the next several scenes, we'll explore what mutual funds are, their types, importance, risks, and how they're regulated, especially in the Indian context. We'll also touch on related instruments like venture capital and global fundraising tools. Let's start by understanding the basic definition and structure of mutual funds. Mutual fund is essentially a collective investment scheme. It gathers surplus funds from various investors and invests them in a mix of securities like stocks, bonds, and money market instruments. The idea is simple: small drops make an ocean. Investors buy units of the fund, and each unit represents a share of the fund's holdings. This structure allows even small investors to participate in markets they might not access individually. The fund is managed by professionals who aim to maximize returns for all investors, so whether you invest a little or a lot, you get a proportional share of the fund's performance. Mutual funds have several defining features. First, they belong to the investors who contribute the money. However, since not all investors can manage the fund, professionals step in to handle investments for a fee. The pooled money is invested according to the fund's objectives. Some focus on specific sectors while others diversify widely. Each investor receives units based on their investment size, ensuring everyone has a stake in the fund's portfolio. This structure provides access to a wide range of securities, making mutual funds a flexible and inclusive investment option. Mutual funds come in various types, mainly classified by how they operate in their investment patterns. On the operational side, funds can be close-ended or open-ended. Close-ended funds have a fixed corpus and duration, while open-ended funds allow investors to buy or sell units at any time. On the investment side, funds might focus on income, growth, or a balance of both. This variety ensures there's a mutual fund for almost every investor's needs and risk appetite. Close-ended mutual funds have a predetermined size and duration. Once the target amount is raised, no new investors can join. These funds are typically listed on stock exchanges, allowing existing investors to trade their units. At the end of the fund's term, all assets are liquidated and proceeds distributed among unit holders. While they offer potential for capital appreciation, investors should note that all gains are realized at once, which may have tax implications. Open-ended funds are more flexible. There's no fixed size or duration, and investors can buy or sell units at any time. These funds are not traded on exchanges. Instead, the fund itself handles all transactions. Investors enjoy instant liquidity much like a bank account and can enter or exit the fund as they wish. The main goal here is income generation, with regular dividends and the option to reinvest or withdraw as needed. Income funds are designed to provide regular income to investors, often through dividends. They invest primarily in fixed income securities like debentures and bonds, making them suitable for retirees or those seeking steady returns. The focus is on generating periodic payouts rather than capital appreciation. These funds are ideal for conservative investors who prioritize stability over high returns. Growth funds aim for capital appreciation by investing in equities with high growth potential. These funds take on more risk, seeking higher returns over the long term. While they may occasionally pay dividends, their primary goal is to increase the value of the investment. Growth funds are best suited for investors with a higher risk appetite and a longer investment horizon, such as salaried professionals or business owners. Balanced funds, also known as income-cum-growth funds, combine the features of income and growth funds. They invest in a mix of equities and fixed income securities, aiming to provide both regular income and capital appreciation. This balance makes them suitable for investors looking for moderate risk and a blend of stability and growth in their portfolios. Specialized funds are tailored to meet the needs of specific investor groups or sectors. Examples include pension funds, widow funds, or country-specific funds like the Japan Fund. These funds often open doors for foreign investors to participate in domestic markets, providing targeted exposure and addressing unique investment goals. Money market mutual funds are open-ended funds that invest in highly liquid and safe instruments like commercial paper, certificates of deposit, and treasury bills. These funds are relatively new in India and are regulated by the Reserve Bank of India. They offer safety and liquidity, making them a good choice for investors seeking short-term parking of funds with minimal risk. Mutual funds play a crucial role in the economy. They channelize savings into productive investments, offer diversified portfolios, and provide better yields due to large-scale operations. Managed by experts, mutual funds make investing accessible and affordable even for small investors. They also offer tax benefits, research services, and simplified record-keeping, making them a convenient and efficient investment option. One of the biggest advantages of mutual funds is portfolio diversification. By pooling resources, mutual funds invest in a wide variety of securities, reducing the risk associated with individual investments. This approach follows the principle of not putting all your eggs in one basket, helping investors manage risk more effectively. Mutual funds can provide better yields compared to individual investing. With large pools of capital, funds can buy and sell securities at better prices, reducing transaction costs. This scale also allows for more efficient management and potentially higher returns for investors, making mutual funds a cost-effective investment solution. Mutual funds are managed by experienced professionals who make informed investment decisions on behalf of investors. These managers use research, analysis, and market insights to optimize the fund's performance. This expertise is especially valuable for investors who may not have the time or knowledge to manage their own portfolios. Certain mutual funds offer tax benefits, adding to their appeal. Additionally, many funds allow investors to switch between schemes, providing flexibility to adapt to changing market conditions or personal goals. This flexibility is a unique advantage not commonly found in other investment options. Mutual funds are accessible to investors with even small amounts of money. They offer high liquidity, allowing investors to buy or sell units easily. This makes mutual funds an attractive option for those seeking both affordability and convenience in their investment journey. Investing in multiple securities individually can be complicated and time-consuming. Mutual funds simplify this process by handling all record-keeping, including dividends, bonuses, and transactions. Investors receive consolidated statements, making it easier to track and manage their investments. Any investment, mutual funds carry risks. Market risks arise from fluctuations in security prices, while scheme risks depend on the nature of the fund. Investment risks relate to the fund manager's decisions, and business risks stem from the companies in which the fund invests. Political risks can also impact returns due to changes in government policies. Understanding these risks helps investors make informed choices. Net asset value, or NAV, is a key concept in mutual funds. It represents the per-share market value of the fund and is calculated by subtracting liabilities from total assets, then dividing by the number of outstanding shares. NAV is updated daily and determines the price at which investors buy or sell fund units. However, NAV alone doesn't measure a fund's performance. Total returns are more important. Let's look at a simple example. Suppose a mutual fund has $45 million in securities and $5 million in cash, totaling $50 million in assets. If liabilities are $10 million, the fund's net value is $40 million. With 4 million shares outstanding, the NAV per share is $10. This calculation helps investors understand the value of their investment at any given time. NAV differs from stock prices. Stocks are traded on exchanges and their prices are set by supply and demand. Mutual fund units, however, are bought and sold at NAV, which is determined by the fund's underlying assets. While stock prices fluctuate throughout the day, NAV is calculated once daily after market close. India, mutual funds are regulated by SEBI under the SEBI Mutual Funds Regulations 1996. These rules ensure investor protection and proper functioning of funds. Mutual funds must be set up as trusts with clear separation between asset management companies and trustees. SEBI oversees registration, investment norms, and reporting requirements, ensuring transparency and accountability. CBI's guidelines cover various aspects of mutual funds. Money market funds are regulated by RBI, while others fall under SEBI. Funds must be established as trusts and managed by separate asset management companies. Each scheme requires SEBI registration, and investment is limited to transferable securities. These rules help maintain the integrity and safety of the mutual fund industry. Transparency is key in mutual funds. SEBI requires funds to submit audited annual statements, semi-annual accounts, and quarterly reports on net asset movements. This ensures investors have access to accurate and timely information, helping them make informed decisions about their investments. Venture capital is long-term risk capital provided to high-potential, high-risk projects, often in technology sectors. Venture capitalists not only invest money but also offer managerial support to new entrepreneurs. Their goal is to help businesses grow and eventually profit by selling their equity at a premium once the company succeeds. Venture capital typically involves equity participation, convertible debt, or long-term loans. Investments are made in high-risk, high-growth projects, especially those commercializing new ideas or technologies. Venture capitalists become co-promoters, sharing both risks and rewards, and remain involved in the business until it matures and they can exit profitably. Venture capital financing occurs in stages: seed finance for idea development, startup finance for launching the business, additional finance for early growth, and establishment finance for expansion and stability. Unlike traditional lenders, venture capitalists may invest from the very beginning, supporting innovation and entrepreneurship. India's venture capital industry includes major players like Kalari Capital, Matrix Partners, Nexus Venture Partners, and Indian Angel Network. These firms focus on technology and early-stage investments, supporting startups and driving innovation. Their involvement has helped many Indian companies grow and succeed globally. Indian companies can raise funds internationally through instruments like foreign currency convertible bonds, FCCBs, global depository receipts, GDRs, American depository receipts, ADRs, and external commercial borrowings, ECBs. These tools help companies access foreign capital, diversify funding sources, and expand globally. Each instrument has unique features and regulatory requirements, making them suitable for different fundraising needs.